Welcome back to Investing Talk podcast. Today, we're focusing on a company that's made, well, one of the most interesting strategic pivots we've seen all year. It's sitting right at that crucial intersection of digital assets and AI infrastructure.
That's right. We're looking into the sources on IREN, this digital infrastructure player that's just seen absolutely explosive growth, and it's commanding a huge market cap now. Our mission today really is to cut through the noise, separate the hype from the reality, and answer that key question you're likely asking. Is IREN a good time to buy right now?
Yeah, we've got a whole stack of fresh reports here. They cover everything from their, frankly, jaw-dropping financials to their strategic position, their competitive advantages. We'll unpack the recent operational performance, take a look at the financial health, what's supporting this massive expansion, and review those important short-term catalysts that could really move the share price in the next few months.
Okay, but before we dive into all the numbers, we do want to ask you to subscribe, like, and maybe comment on this discussion. It really helps us get these analyses out there. And importantly, if there's a specific company you'd like us to examine next, please just leave a comment below. We really are listening.
Absolutely. So let's start with the market reaction because honestly, the stock's performance has been just staggering. If you look at the chart, IREN's up 300% year to date. But here's the real kicker. The acceleration was incredibly dramatic. Shares jumped, 87% in just 1 month back in July, and they hit an all-time high of $49.39 just recently on September 25th. What on earth ignited that?
Right, and that extreme run-up, it wasn't just random market froth, it was a direct reaction to a major strategic announcement they made back in July. IREN made a really bold move. They explicitly pivoted away from just pure Bitcoin mining expansion. Now, they were already a top player operating at massive scale, but they effectively decided to cap their mining expansion at 50 exahashes per second, 50 EHs.
That's a huge call. I mean, they were essentially walking away from almost guaranteed profits in Bitcoin mining to chase this high imagined promise of AI.
Precisely. They announced they'd prioritize building a, quote, world-class data center platform. The focus shifted squarely to large-scale AI cloud infrastructure. And this shift, it proved instantly magnetic to growth investors, the ones who really prioritize those high recurring revenue streams over, say, volatile commodity exposure like Bitcoin.
And the company didn't just talk the talk. They backed that strategy up with enormous capital commitments almost right away.
Oh, they absolutely did. In September, they announced a massive procurement deal. We're talking nearly $750 million, $674 million, specifically to double their AI cloud fleet.
Wow.
Yeah, that means they're scaling up super fast to about 23,000 top-tier GPUs.
23,000 GPUs. Okay, that really does sound like a moonshot investment. What's the expected return on that kind of hardware spend?
Well, the target is certainly ambitious. But given the current demand for AI compute, it seems achievable. They're aiming for over $500 million in annualized recurring revenue, ARR, from these new AI cloud services. And that goal, it really validates their decision to diversify, to not just be seen as a Bitcoin proxy stock.
And we can already see some early signs of success from this strategy, right? In their recent financial report, the one covering Q4 and fiscal year 2025, which came out in August, this was before the full AI pivot really kicks in.
Yeah, the numbers there are incredibly strong. It validates the underlying health of their core business, even before the big AI push. Revenue soared to $501 million. That's up 168% year over year.
Wow.
And maybe more importantly, they made a decisive swing to net profitability. They reported $86.9 million in net income compared to a loss the year before.
And if we look at the operational cash flow, the results there are maybe even more striking.
Yes. Adjusted EBITDA, that cash flow measure before things like depreciation and taxes, it's a great barometer for operating strength. It hit $269.7 million. That's a massive 395% increase. It signals they're generating substantial cash internally to help fund these new ventures.
What's fascinating here, though, is that early glimpse we got into the AI segment itself. Okay, their Bitcoin mining was robust, operating at 44 EHs hash rate. But the new AI cloud, it only generated $2.4 million in revenue initially, but, and this is the key part, at a staggering 98% gross margin.
98%. I mean, that's essentially pure profit on every dollar of revenue right now at this early stage. And that margin is precisely why institutions are so excited. It signals that if, and it's an if they can maintain high hardware utilization, this AI cloud platform is going to be an absolute cash engine.
But how sustainable is a 98% margin? Once competitors start stacking hardware too and pricing pressure inevitably emerges, that feels like a big execution risk point.
It absolutely is an execution risk, no doubt. But they are laying the groundwork for serious scale, which should help sustain profitability longer term. They're building massive hyperscale facilities. We're talking 750 megawatts planned in Childress, Texas.
750 megawatts.
Yeah, and 2,000 megawatts planned for Sweetwater, also in Texas. Their British Columbia site is designed for over 60,000 GPU capacity. Just to put 750 megawatts in perspective, that's enough power for hundreds of thousands of homes.
Yeah.
So the physical infrastructure isn't just large, it's being built for like decades of operation.
Okay, so we've established operations are booming, the early AI margins are, well, breathtaking. But this kind of rapid growth demands equally robust capital. Let's turn the conversation now to the balance sheet. What's the foundation supporting this really aggressive, capital-intensive expansion?
Well, this is where IREN really stands out, I think, from many other high-growth, high-volatility plays. The balance sheet is rock solid. They maintain a strong net cash position and, critically, zero net debt.
Zero net debt. While doing this kind of aggressive build-out, that's extremely rare.
It really is. Right now, they're sitting on over $425 million in cash. And this financial flexibility, it means they aren't hostage to external markets at the moment. They can deploy capital strategically, secure that crucial hardware, get the facilities built, without necessarily needing to immediately dilute shareholders or take on expensive debt.
And analysts seem to view this as a sustainable path, right? The growth forecasts for next fiscal year look aggressive, but they seem backed by this AI scale-up plan.
Absolutely. The consensus forecast is for revenue to more than double again to $1.13 billion in fiscal 2026. That's about 124.5% growth. But the earnings leverage is where it gets even more compelling, precisely because of those potentially high AI margins we talked about.
Right. Tell us about the projected earnings increase.
Okay, so earnings per share, EPS, is forecast to soar. From about $0.39 trailing 12 months now, the forecast is for $1 in FY 2026. That's a projected 156% annual jump in EPS. It shows just how rapidly these high-margin services are expected to translate into actual shareholder value.
Okay, so this brings us to their competitive edge, and this is arguably the most crucial part of the whole thesis, this dual engine approach they have. They're not just an AI company, they're sort of a hybrid utility.
That hybrid approach really is their competitive moat, I think. The cash flow generated by their still top-tier Bitcoin mining operation acts like a resilient financial firewall. It effectively helps fund the high-growth, potentially high-margin AI expansion. And that insulation allows them to build capacity faster, maybe cheaper, than pure-play AI competitors who might constantly need to go back to the market for capital.
But what about the hardware itself? That AI expansion needs those cutting-edge GPUs, which are notoriously scarce. You can't just, walk into a store and buy 23,000 top-tier GPUs. How did they secure that supply?
Well, that's where some strategic genius seems to come in. IREN secured a preferred partnership with NVIDIA. And this partnership isn't just a title, it sounds like a strategic lifeline. It reportedly guarantees them timely access to those bleeding-edge GPUs, potentially insulating them from the supply chain bottlenecks that are really crippling some of their rivals. Getting into this high-margin computing services market early is probably only possible because of that relationship.
And we can't overlook the ESG angle either, which isn't just about looking good here. It seems to be a structural cost advantage, too.
Precisely. Their whole strategy hinges on operating renewable-powered data centers. They've got them across Australia, the US, and Canada. Using clean, often locally sourced energy gives them a structural tailwind because it fundamentally lowers their long-term energy costs. And energy is the single biggest operating expense in both mining and data centers.
Right.
Plus, it simultaneously appeals to those big institutional investors who often have ESG mandates. So it's kind of a win-win cost mitigation strategy.
Okay, let's pivot now to the immediate horizon. What does the technical picture look like for the stock right now? And maybe more importantly, what are the crucial dates investors really need to circle on their calendars?
Okay, technically speaking, the persistent uptrend is definitely confirmed. The stock's trading comfortably above both its 50-day and 200-day moving averages. Solid trend. However, and this is a big however, we have to address the sheer volatility.
Yeah, the beta is listed at 4.04, which basically means if the general market moves 1%, IREN could theoretically move over 4% in the same direction. It's definitely a high conviction, but also high risk play.
Exactly. So for maybe shorter-term traders, the technical outlook suggests a likely trading range between, say, $38 on the low end and maybe $55 on the high end. The key battleground right now is that previous resistance level, roughly $47 to $49. A clean, decisive breakout above that zone on good volume would likely signal a big new upside leg, probably driven by more institutional money flowing in.
And the next 3 months specifically seem packed with potential volatility triggers.
They really are. The most significant event is probably the Q1 FY 2026 earnings report, which is scheduled for December 2nd. This release is going to be a high-stakes moment because it'll be the first detailed look at performance after that massive $674 million AI fleet doubling and the subsequent run-up in the stock price. Investors will be intensely scrutinizing the AI cloud revenue growth. They really need to show that utilization rates are ramping up quickly.
But even before December, we have some flow catalysts to watch, right? October 14th is the institutional ownership disclosure date. That's when the 13F filings come out. Those will reveal which major institutions were actually buying shares during that explosive third quarter run-up. That could be very telling.
Right. And then index activity follows on November 15th with the ETF rebalancing. This can sometimes significantly impact trading volume and share price just through mandated index inclusion and the resulting fund flows. It could potentially reinforce the uptrend if index funds are forced buyers.
And market sentiment, generally speaking, seems overwhelmingly optimistic going into this period.
It does. Of the, say, 10 to 15 analysts covering IREN, 12 maintain buyer ratings. And while the consensus price targets are already robust, the high estimate target sits all the way up at 78 guides. That big gap between current trading and that high estimate really showcases the immense speculative upside analysts see if the AI execution goes flawlessly. We also know from earlier filings that institutional investors showed pretty notable accumulation throughout Q2 and Q3 of 2025 already.
Okay, now let's touch on the rumors. The speculative buzz that's always swirling around hot stocks like this. Stuff that could either fuel the next leg up or, create some extreme volatility.
Well, the primary buzz seems to center around contracts. There's persistent market chatter suggesting a potential large-scale cloud partnership is in the works, maybe with a leading hyperscaler, one of the big cloud providers, or perhaps a major chip maker. Landing a contract like that would instantly anchor their GPU utilization rates and really validate that huge multi-million-dollar investment.
And reflecting the massive capital needed to actually build out those giant 750 milliW facilities we talked about, there's also intense speculation around financing, isn't there?
Correct. The market seems to anticipate a significant capital raise is probably coming, potentially involving convertible debt, maybe green bonds, specifically to fund further AI and data center build-out. I mean, this is pretty common for companies operating at this scale, especially when they're in such a hyper-growth phase. It costs a lot to build this stuff.
And finally, there are those, unconfirmed but certainly tantalizing rumors of maybe a hostile takeover attempt or perhaps a strategic stake being taken by one of the big U.S. techno-industrials.
Yeah. That particular rumor, whether true or not, kind of indicates just how structurally valuable this type of infrastructure, green-powered dual engine built for high-density computing with reliable energy costs, is becoming to the biggest tech players out there. They might see the physical infrastructure itself as a massive strategic asset.
Okay, let's try and bring this all together then. What's the final word for our listener thinking about IREN right now?
Look, the overall investment thesis, based on the sources, remains highly bullish. We'd probably rate it something like a 9 out of 10. But, and this is crucial, it's contingent entirely on execution. The rationale is that exceptional, diversified revenue and earnings growth potential powered by this really strategically smart AI cloud pivot. And importantly, that pivot is supported by rock-solid fundamentals, zero net debt, high cash reserves, and strong technical momentum in the stock.
But as always, no stock comes without risks. We have to remember that.
Absolutely. The key risks here are, 1, the continued exposure to Bitcoin price volatility. Yes, it's mitigated somewhat by the AI diversification, but it's still there. And crucially, investors absolutely must monitor the execution risk. That means watching if they can rapidly ramp up the AI cloud segment, deploy all that hardware effectively, and most importantly, sustain high utilization rates on those expensive GPUs. This is definitely a marathon, not just a sprint.
So IREN is presented here as potentially attractive for both short-term trading, maybe trying to capitalize on those imminent flow and earnings catalysts we discussed, and also for longer-term investment if you're targeting that structural growth story in critical AI infrastructure.
Right. And this raises maybe one final important question for you, the investor, to really ponder. Given the company's incredibly aggressive scale-up goals, remember they just recently, in September, named their previous chief capital officer as the new CFO. That move emphasizes capital markets expertise right at the top. So does this strategic leadership shift maybe suggests that the single most material catalyst in the next 3 months isn't necessarily announcing a simple customer contract win, but rather a major capital raise like convertible debt or green bonds, specifically designed to fund the next massive leg of growth. It certainly suggests a very strong focus on financing the future build-out.